Hi all. So today we're going to get into actually my favorite chapter of the text. This is where we put everything we've talked about up to this point together to explore how policymakers can affect and influence aggregate demand and attempt to offset recessions. And the ways we can do this is through the monetary and fiscal policies we've discussed up to this point. So if you remember chapter 16 and 17, we introduced the Federal Reserve, what their role is, what they do, and we've talked up about how the government, as a part of the GDP, can ultimately spur growth by spending more. But how do they do this? And what are the policies available? And why does this work? Well, that's what we're going to talk about today. So first off, let's start with how monetary policy influences aggregate demand. Now, we've mentioned some of these concepts in the last chapter, but we'll revisit them. So there's three effects monetary policy has on aggregate demand. The first is the wealth effect, and that is the idea that a lower price level raises the real value of households' money holdings, which as a part of their wealth. So higher real wealth stimulates consumer spending and thus increases the quantity of goods and services demanded. Now, the next part of this is the interest rate effect, and that is that a lower price level reduces the amount of money people want to hold. As people try to lend out their excess money holdings, the interest rate falls. The lower interest rate stimulates investment spending and thus increases the quantity of goods and services demanded. And finally, the exchange rate effect, and that is when a lower price level reduces the interest rate, investors move some of their funds overseas in search of returns. So a higher interest rate is incentivizing a higher investments overseas. So this movement of funds causes the real value of the domestic currency to fall in the market for foreign currency exchange. And we've mentioned and explained this, why this occurs in chapters 19 and 20 when we developed open market theories or open economy theories. And because of this, domestic goods become less expensive relative to foreign goods. This change in the real exchange rate stimulates spending on net exports and thus increases the quantity of goods and services demanded. This brings us to the theory of liquidity preference. Keynes's theory of liquidity preference was the idea that the interest rate adjusts to bring money supply and money demand into balance. That is, the same money supply that is primarily influenced by the Fed and open market operations, as well as through the discount rate, is brought into balance with the demand for it through interest rates. Now, what is money demand? Well, under the theory of liquidity preference, this is affected by the interest rate. This is the amount people want to hold of money and how much they want to save. So if there is a higher interest rate, we conceive this as incentivizing higher savings rates, right? So if you can earn more money by putting more cash in your savings account, theoretically, you should then put more money in your savings account, which would reduce your money demand. Similarly, if you have a lower interest rates, that means that you're not making as much in savings, and this incentivizes spending and a higher demand for cash liquidity. Why is this? Well, the interest rate serves as the opportunity cost of holding liquid currency. So if you have a low interest rate, that means there's not very much, that's a very low opportunity cost to putting cash in the bank. However, if you have a higher interest rate, that means there's their opportunity cost by not saving money. So equilibrium in the money market, this is where the interest rate establishes a balance between the money supply set by the Fed and the money demand as determined by the interest rate. And note, though, that in this market, the money supply is vertical because it's set by the Federal Reserve policy. So equilibrium in the money market, if we zoom in this graph, we can see how this breaks down. We have, again, our interest rate on the y-axis. We have our quantity of money on the x-axis. As we said, because Federal Reserve policy fixes the money supply, it is straight up and vertical. And the equilibrium interest rate then is the point brings the money demand into balance with the money supply as determined by the Federal Reserve. Now notice that again, at higher interest rates, there's a lower quantity of money demanded, and at lower interest rates, there's a higher quantity of money demanded. So the downward slope of this AD curve, it reveals to us that an increase in the price level leads to a rightward shift in the demand for money overall, which leads to an increase in interest rates to offset the new demand. So basically, the relationship here of the downward sloping aggregate demand curve is that, as we said, we've been looking at the opportunity costs created by holding money and the demand for money. But if the price level increases, ultimately what this does is this explains that there is a rightward shift in the money demand. So if we look through the breakdown here, we can see that an increase in the price level leads to a reduction in the aggregate demand curve. And so again, just to work through this, what's going on here is the aggregate demand curve informs how much money we want in the money market. And we're going to look through a process of how a decrease or increase in the price level then functions through the economy to lead to an increase in the money demand, higher interest rates, and a decrease in the quantity of goods and services. So first off, let's go. The first move, of course, is this increase in the price level. This, of course, inspires us to reduce aggregate demand. By this reduction in aggregate demand, we see that there is an increase in the demand for money because with a higher price level, more cash is required to be held in order to purchase the same goods as before. With an increase in the demand for money, this of course corresponds to an increase in the equilibrium interest rate. So a higher interest rate is the result of the higher demand for money. But ultimately, what this turns around and does is it in turn reduces the quantity of goods and services demanded further. Why is this? Well, higher interest rates, right, are the cost of investment. And so if the cost of investing has gone up, investing will go down, which leads to a decrease in aggregate demand. And so this is sort of the cyclical nature that we're looking at here. So again, 4 steps. An increase in the price level leads to an increase in the demand for money necessary to purchase goods at the higher price level. With an increased demand for money, this means there's a higher equilibrium interest rate. And with a higher equilibrium interest rate, investment is disincentivized, which, since investment is a part of aggregate demand, reduces the quantity of goods and services demanded. So how does the money supply affect this? Well, or how do changes in the money supply occur, and then how do they affect this market? Well, let's just consider that when the Fed increases the money supply, it does this through lowering interest rates, which increases the quantity of goods and services demanded for any given price level, leading to a shift in the aggregate demand curve right. However, when the Federal Reserve decreases the money supply, it leads to higher interest rates, which decreases the quantity of goods and services demanded for any given price level and leads to a shift in the aggregate demand curve left. So let's consider in the next slide the benefits of a monetary injection. What we can see here is that when the Fed increases the money supply, so it shifts from our blue line to our red line, this ultimately leads to a reduction in the interest rate. With a reduction in the interest rate, this now means that investment is now relatively cheaper, which incentivizes more investment. And with a high investment, we see an increase in the aggregate demand curve rightward. So as we can see here, the Fed increases the money supply, lowers the equilibrium interest rate, and leads to an increase in the aggregate demand curve. Now, there's some obviously interesting policy conclusions that come from this. What this means, right, is that in the event of a recession or any drop in aggregate demand, theoretically, the Federal Reserve, by increasing the money supply, can spur consumption and investment. Another thing, right, like your credit cards and home loans, et cetera, these are all things that rely on interest rates as well. So if the Federal Reserve has a more generous interest rate policy, this encourages consumption. So, what's the role of interest rate targets in federal policy? Well, monetary policy can be described in 2 ways. We have the money supply, of course, how much money is out there, and then also the interest rate, or the price of borrowing and saving. Since interest rates easier to keep tabs on and measure, this is the primary variable typically used by the Federal Reserve to measure money supply. However, there is a problem with the interest rate. Typically, what the Federal Reserve and other central banks do is they use targeted ideas of interest rates. So what is the ideal interest rate you're aiming for? If you can reduce interest rates further, then this should spur money demand and consumption and investment. So this is an easy, tricky policy. However, there is this question of what happens when you've been too low for too long. And this is the idea of the zero lower bound. And the zero lower bound problem is the idea that there is a liquidity trap. And that is the idea that monetary policy loses all effect at 0% interest rate or near 0% interest, i.e. the zero lower bound. There's some debate if this is true. Is zero the end, or do negative interest rates find success? So if we dropped our interest rates further to where we're actually charging people money to save money, does that lead to higher borrowing and spending? We're not sure. But the reason why the liquidity trap is a serious problem is because, again, at what point does 1% and 0.5% and 0% seem dramatically different. At what point do these numbers lead to a marginally more significant change in people's desire to loan or borrow? Like, is there someone that's been holding out a 0.5% interest rate that hasn't been to this point? And the answer is, if this is, then we consider that the monetary policy has lost its effect. One of the big questions this has become is for an area of policy called quantitative easing. This is a strategy that was developed by the Federal Reserve in lieu of the Great Recession of 2008. And this is the purchasing of corporate debt. So maybe while people might not necessarily be directly wanting to borrow and invest, if the Federal Reserve steps in and invest in private businesses, does that perhaps stimulate the economy in a way otherwise unable to at this point? But monetary policy isn't the only thing available to us. We also have fiscal policy as a way to influence aggregate demand. Now, fiscal policy is the setting of the level of government spending and taxation by government policymakers. And these changes in government purchases have two different effects. It can add to the output of the economy, but it's also limited in its ability to affect the economy by two aspects. And these two aspects are the multiplier effect and the crowding out effect. And the multiplier effect, or the fiscal multiplier, or the spending multiplier, is a lot like the money multiplier we discussed in chapters 16 and 17. The idea that for every dollar deposited, more deposits created. That's the same concept in the spending multiplier. The crowding out effect we've also visited when we discussed the financial markets and financial institutions and balanced budgets and government spending. But we're going to focus first on the multiplier effect here. So what the multiplier effect suggests is that there's additional shifts in aggregate demand that result from expansionary fiscal policy, i.e. the government spending more, which in turn increases individuals' incomes and thereby increases consumer spending. So the idea here is that the government purchases of $20 billion initially, that increases aggregate demand by $20 billion. However, the spending of $20 billion, right, this now means more people have wages, this means more companies have made money, they may hire more people, employees feel more comfortable in their jobs, they turn around and spend money, and the spending created by those government purchases is effectively a multiplier on the initial spending of the federal government. So this multiplier effect can amplify the shift in aggregate demand. Now, there's a way we can calculate this, and there's a formula for spending multiplier, and that multiplier is basically 1 over 1 minus NPC, where MPC means marginal propensity to consume, and this is the likelihood and the percentage you spend of each dollar you receive. So to give you an example, if I gave you $10 and you spend $8 and save $2, your marginal propensity to consume is then 80%. You consumed 80% of the money I gave you. So if we consider this in terms of the spending multiplier, what we think then is for every dollar the government spends, whatever percentage people are willing to spend of that money further, this is the spending multiplier. Now, there's other applications of the spending multiplier effect. This relationship exists for every transaction that affects GDP. Consumption, investment, government purchases, or net exports. So it's not just the government that creates a spending multiplier. And the question is, if the government is required to either borrow or tax to spend, we then have to consider the consequences of the government taking spending and limiting the multiplier effect from other industries. And this gets us to the crowding out effect, which this is the offset in aggregate demand that results when expansionary policy raises the interest rate and thereby reduces investment spending. So graphically, we can see the idea here. If the government chooses to spur aggregate demand by increasing their purchases, this ultimately leads to, one, a higher price level, which in turn leads to an increase in the spending, which the increase in spending then increases the monetary demand. So we have a rightward shift in monetary demand. With this rightward shift in monetary demand, we then have an increase in the equilibrium interest rate, which this increase in the equilibrium interest rate, of course, that disincentivizes investment, this disincentivizes borrowing, this disincentivizes private consumption on credit. And so what we find here is that while the government spending does increase the economy $20 billion initially, it is partly offset due to the decrease in aggregate demand brought on by the crowding out effect. So this leads us to a complicated question. Your decision of whether or not the government should be spending more or not depends on whether or not you think the fiscal multiplier, how much the government is creating by spending, is greater or less than the crowding out effect, how much government spending is reducing private consumption and private investment. Now, there's another aspect of fiscal policy. Government can change taxes. So, by reducing taxes, the government effectively increases household income. Similarly, increasing taxes reduces household income. And taxes similarly impact the multiplier and crowding out effects. So if taxes are higher, right, we would expect a lower spending multiplier because there's less income and there's less dollars to be created by the spending. Or to give you another example, right, when you spend $10 at a store, you don't just spend $10 on the good, right? You spend $10 plus 10 times the tax rate. And so the full value of your money doesn't even get back because you have higher taxes that kind of knock off that value of money. So this is an aspect of the government can reduce taxes if it wants to spur consumption. The caveat here is that expectations are vital in determining the effects of this. Short-term tax cuts mean people barely adjust their habits or fully build in responses to the anticipated tax changes. If the government's like, hey, we're dropping taxes, your income taxes to just 6% for the next few months, but then we're going to pump it back up and reclaim it, right? People are just like, okay, so my taxes aren't really that different. But this does leave some serious questions. How can the government use policy to stabilize the economy? Well, the argument for active stabilization is that when taxes are increased, decreasing aggregate demand, theoretically the Fed can offset this by increasing the money supply. But as a rule, policies should avoid orchestrating economic fluctuations themselves. There's some institutional reasons for this. The Economic Stabilization Act of 1946, for example, explicitly states economic stability as the goal of federal policy, defined as full employment and production. Secondly, more expansive implication of the ESA is that the government should respond to economic downturns. To quote kind of humorously a former Fed chair, the Federal Reserve's job is to take away the punch bowl as the party gets going. Now, what does it mean by this? The Federal Reserve is supposed to keep low interest rates as long as the economy is struggling. But once the economy starts to recover, the Federal Reserve's job is to start bringing back up interest rates and rebalance markets. And so that's kind of the punch bowl. Once things are getting good and things are getting happy, the Federal Reserve goes, oh, wait, no, we don't want to loan as much money now. But there's a case against active stabilization, and this argument really depends on 2 points. The first is that deviations are short-term and markets self-correct. So just to give you an example, in COVID, jobs have rebounded significantly. I believe it's like 7%, 7.5% last quarter. This rebound in some economists' view, is a evidence of the market self-correcting. That while yes, COVID has hit the economy is able to self-correct quite quickly and recovery, and the additional stimulus might not be beneficial. And similarly, to this end, the idea is that their optimal policy is to target long-term objectives, not short-term objectives, not short-term fluctuations, but to focus on long-term growth. And the key point they use to attack active stabilization is that active policy has a lagged effect. When the solution is needed, the political process delays action, which by the time the action is finally taken, there's lag until the policy takes effect. By that point, the policy may just be distorting a recovering economy. That's one of the questions currently going on, is now as the economy is recovering from COVID, does this mean we need a second stimulus bill, or does a second stimulus bill just create market distortions, which ultimately sabotages the industry in other ways? Makes it a technical and difficult question. But if you also want some evidence for what drives economists that believe this very frustrated, just think that for the past 4 months, Congress has been negotiating another second round of stimulus bills and has yet to pass it. Automatic stabilizers. There is a final aspect of fiscal policy, and that is these automatic stabilizers, which are fiscal policy changes designed into it that stimulate aggregate demand when the economy goes into recession without policymakers having to take any deliberate action. The tax system, for example, can adjust automatically to reduce the amount of taxes collected by the government because all taxes are closely tied to economic activity. But there's another aspect of this, government spending. Unemployment insurance benefits kick in regardless of if the economy is doing well or bad when someone loses their job. When many people lose their jobs, then, unemployment insurance benefits serve as an automatic increase in fiscal spending to cover and meet needs. Similarly, welfare benefits and other income support are ways of helping individuals to keep and prop up aggregate demand in the face of recession. But what's important to note here is these policies aren't sufficient enough to fend off recessions on their own. They're just immediate bandages. In conclusion, I have a few videos I want you to check out. These are macroeconomic office hours. So if you go to mru.org, so type in this link, go to mru.org, check out these videos. They're a great way of working and practicing what happens and what's created by shifts in aggregate demand, aggregate supply. Again, these are just some things I want you to be familiar with. One introduces the concept of double shifts. Um, but beyond that, the final point here to take away is that there is a policy tool belt available to policymakers in order to fight recessions. But as we're going to see in the next chapter, there's some drawbacks to those policies. They don't just work perfectly. The government can spend more, but this will drive up interest rates. Similarly, the monetary policy can increase the money supply, but this will drive inflation. We're not sure quite how this works, why this will always be the case, but we do know it's significant problems that need to be considered when we're constructing good policy. All right, that's all I have for y'all today. Thanks so much. Hope you enjoyed, and our next chapter will wrap us up this semester. Take care.